Welcome back to Part B of Topic 1 lecture. It is here that we will discuss the last 4 learning objectives in Topic 1. In Learning Objective 5, we will explain how investments in capacity affect managerial decision making. So first up, what is capacity? Capacity is simply the upper limit on the amount of goods or services that the entity can provide. There are 2 types of capacity. The theoretical capacity is simply the upper limit on the amount of goods or services if everything works perfectly. So the theoretical capacity does not give any leeway for any machine breakdown, illnesses suffered by the workers, and the like. The practical capacity, on the other hand, allows for normal occurrences such as the downtime of the machine, cash register for example, and perhaps the illness or fatigue of the cashier. Now, there are important questions to ask for the managerial accounting system to address when we're dealing with capacity. The first one is, what is an organization's practical capacity? Number 2, what are the costs of the resources supplied to provide that capacity? And number 3, how have those resources been used in creating value? In answering these questions, it's important to note the difference between the resources supplied and the resources used. The cost of the resources supplied minus the cost of the resources used will give way to the cost of the resources unused. It will be better to give an example in order for us to understand this. All right, so let's suppose that we are paying our employee $22 per, let's just say per day, just for the sake of illustration. So on Monday, let's say the labor cost is paid $22 and the number of pizzas made by this worker is 20, which is the normal capacity of one person making pizza. So what is the cost per pizza on Monday? Well, $22 divided by 20 is $1.10 of labor cost per pizza. Now on Wednesday, let's just say business was quite slow. We still pay our workers $22, but we only needed to make 10 pizzas. That was the only demand. And so the cost of labor per pizza would be $22 divided by 10, $2.20. All right. And then let's say again, on Friday, business is even worse and there was only 1 pizza ordered. All right. We still pay our worker $22, but the person only made 1 pizza. So how much is the cost of labor per pizza? $22 divided by 1, $22. Now, it would be ludicrous to say that the cost per pizza on Monday would be so much cheaper compared to the cost of pizza on Friday. So this scenario has actually something to do with the capacity, the used versus the unused capacity. And the best way to show these calculations is as shown in this table. So the cost of labor resource use, all right, should be computed as shown in column C. All right. On Monday, we have used $22 resource. So resource used on Monday was $22. On Wednesday, the resource used was $11. How did we get that? That's the 10 pizzas times $1.10, the cost per pizza at the practical capacity. So that's 10 times 110, $11. All right. On Friday, the cost of resource use is really just $1.10. The cost of 1 pizza times $1.10. All right. So how about the rest? We are still paying the workers $22, right? Well, the reality is the cost of resource unused, which is shown in column E, is where we will see the difference. All right. The resource supplied every day, Monday, Wednesday, Friday, is the same, $22, because we're still employing one person, one employee. The cost of labor resource use change from day to day depending on our volume, isn't it? $22 on Monday, $11 on Wednesday, and $1.10 on Friday. The resource unused as well change. On Monday, we are at full capacity, practical capacity, so therefore there is zero unused resource. But on Wednesday, we've only utilized our resource for 10 pizzas, and so the resource use is $11. But the resource unused was also $11 because our resource supplied was $22. So 22 minus the resource used of $11 equals the unused resource of $11. All right, you can do that with Monday as well. 22 is our resource supplied minus the resource use of $22, and therefore the resource unused was zero. On Friday, on the other hand, our worst day of the week, we have resource supplied of $22, but the resource use was only $1.10. So the cost of resource unused is $20.90. The difference between the resource supplied of 22 minus the resource used of 110 equals the resource unused of $20.90. In this case, as shown in column D, the cost of labor, the resource used per pizza, will be the same, $1.10 per pizza. All right, it's the unused resource as well as the used resource that will differ depending on the number of pizzas, the volume or the quantity demanded in terms of the pizza production. All right, so once we know this information, our challenge therefore is to ensure that as much as possible we can use the resources supplied. All right, we will try our best to ensure that the unused resources are minimized. All right, let's move on to learning objective 6. Here we'll understand and explain big data. We'll also understand what we mean by data analytics and how they interact with managerial accounting. So first, let's have a look at big data. Big data simply means the massive volume of both structured as well as unstructured data that is so large and complex that is difficult to analyze for insight just using the traditional eyeballing methods, for example. All right, so if you are, let's say, selling so many different products and you are looking at the sales over the entire year, 365 days, 12 months, 52 weeks, and you've got, let's just say, hundreds of products. All right, you might want to know which particular product are most saleable during different seasons, winter, summer, autumn, as well as spring. You might also want to know which day of the week are certain products more saleable. All right, but with such massive volume of data, you can't easily get the insights using the traditional method of just looking at the data, eyeballing the trends, for example. All right, what about data analytics? Data analytics is simply the process of making sense this big data and developing true and helpful insights. So in my example, if you really want to know which days of the week, for example, a particular product is most saleable, we will ensure, for example, that that product has enough stock during that period of time. All right, if it's winter time that a particular product or products are most saleable, then we will ensure that we have enough for us to satisfy the customers. All right, if we're talking about advertising the product, we might want to know which age range of our target customers are susceptible to buying that particular product. And at the same time, we can target our advertisement to be shown in a particular time of the day. So for example, if cereal is our product and we're targeting, let's just say, students, all right, when would the students be most likely watching the advertisements? All right, if it is the age range of primary school students, so they might be watching the TV most likely around 5:30 to 6:30 or 7 o'clock before dinner. After dinner, they have to go back to doing their homework or something like that. So companies will be able, via data analytics, to make sense of the big data and therefore use the helpful insights they find to make decisions. What about data governance? This relates to activities to ensure that such big data is usable and valid. So data governance would include such things as storing the data in a place whereby you can easily access it when you need to do your analytics, and ensuring that data is not corrupted so that it is usable and valid whenever you're doing your analysis of the data. What about data science? This has to do with the process of drawing useful insights for decision makers from the analysis made from big data. So, in a sense, data science and data analytics are very much interrelated, because making sense of big data and drawing useful insights for decision makers will be already crossing over to data science. All right, let's move on to learning objective 7. Here we'll discuss the professional organizations and certifications in the field of managerial accounting. So pretty much we are looking here at management accounting as a career. All right. We know that managerial accountants are the providers of information, and they're often in touch with the heartbeat of the organization. As such, they frequently interact with so many different people: sales personnel, financial analysts, the production people, and the managers at all levels. So to keep up with new developments in their field, management accountants often belong to a professional organization. All right. So in the field of managerial accounting, the professional organization that most of the management accountants will be part of is the Institute of Management Accountants, the IMA. So the IMA has a number of functions. Number one, they publish management accounting and research studies to ensure that the members, the management accountant members, are up to date with what's going on in the industries that they belong to, as well as in the profession. It also administers the Certified Management Accountant program. Before you can be a member, you need to have the necessary qualification that is required of a management accountant. And finally, IMA develops standards of ethical conduct for management accountants. This is really important because any profession or any professional organizations must adhere to the code of professional standards. Now, why would you bother, for example, to be a member of IMA? Well, one study conducted of practicing managerial accountants in the United States showed that professionals with a certification, at least a member of the professional organization, actually earns almost 50% more in average total compensation compared to their non-certified counterparts, those management accountants that are not part of the professional organization. So I guess that is a good monetary incentive in the sense to become a member of the IMA. If you are a member of the professional organization, also the employers as well as your customers, for example, or other people that you're dealing with kind of know that you are required to adhere by a code of professional ethical standards. All right. And speaking of ethical standards, let's go to learning objective 8, the final objective for topic 1. Here we'll describe the ethical responsibilities and ethical standards that apply to managerial accounting. Ethical behavior by managers in general and accountants in particular is not a luxury or a discretionary good thing to do. It is an absolute necessity for the smooth functioning of the economy. So it is clear from this quote that being ethical is not just a nice thing to do. It is actually an absolute necessity. And therefore, we as accountants, managerial accountants, or managers need to adhere to a set of ethical code of conduct or the standards that are required of our profession. So the IMA Statement of Ethical Professional Practice specifically shows 4 standards, all right? Competence, confidentiality, integrity, and credibility. This is actually a very important part of our career as accountants or management accountants in particular. The stream of corporate scandals in the United States, in Australia, in many different parts of the world has taught us that not only is unethical behavior in business wrong in a moral sense, but it can also be disastrous to the business and to the economy as a whole. So there will most likely be reforms in corporate governance and accounting as a result of unethical behaviors. You probably have heard already of the Sarbanes-Oxley Act in the United States. That's just one example of this corporate governance kicking in because of many corporate scandals that had happened in the United States, particularly in the case of Enron and WorldCom. What does this Sarbanes-Oxley Act did? Well, this act, among other things, requires companies to establish, to assess, and regularly report on their internal controls over financial reporting. So whilst this is on financial reporting, it also impacts on managerial accounting and managers in particular, because as a result of Sarbanes-Oxley Act, the creation of the Public Accounting Companies Oversight Board was established, and it provided auditing standards as well as quality review process that are useful not only in external reporting but also are applicable to management accountants. All right. So what do these standards that we are looking at entail? Well, competence, for example, looks at maintaining an appropriate level of professional leadership, performing professional duties in accordance with relevant laws, regulations, and technical standards, and the provision of decision support information and recommendations that are accurate, clear, concise, and timely. So this requires the managing of risk whenever risk can be recognized. What about confidentiality? Confidentiality meant that as a manager or as an accountant, we keep information confidential except when its disclosure is authorized or legally required. So this means we inform all relevant parties regarding the appropriate use of confidential information, and we must refrain from using confidential information for any unethical or illegal advantage. All right. What about integrity? Whenever you hear the word integrity, you think of a person who is honest and fair, all right? You mitigate actual conflicts of interest. If you are faced with a conflict of interest, you will have to actually excuse yourself because you do not want to be seen to be having conflict of interest. You will refrain from engaging in any conduct that would prejudice carrying out your duties ethically. All right? And this means you abstain from engaging in or supporting any activity that might discredit not just yourself but the profession as a whole. And also, you must contribute to a positive ethical culture and place integrity of the profession above your own personal interest. And finally, credibility. It means that you are communicating the information fairly as well as objectively, free from bias. You will be providing relevant information that could reasonably be expected to influence unintended users' understanding of the reports as well as the recommendations. All right. It also involves reporting any delays or deficiencies in information, timeliness, processing, or any internal controls in conformance with organization policy. And finally, credibility also includes communicating professional limitations or other constraints that would preclude you from executing a responsible judgment or from successfully performing an activity. So, if you know that you don't have enough expertise, that will impact your competence but also your credibility. You are not expected to know everything, but if you know that you have reached your bar in terms of your expertise, then you have to inform the relevant people and get the help that is needed in order for you to be able to perform the task that has been asked of you as a managerial accountant or as a manager. All right. Next, I'd like to go through this problem so that we can use this important information on ethical standards. So here we have a company, Andal Logistics, which is a US shipping company. They have just begun distributing goods across the Atlantic to Norway. The company began operations in 2011, transporting goods to South America. The company's earnings are currently trailing behind its competitors, and Andal's investors are becoming anxious. Some of the company's largest investors are even talking of selling their interest in the shipping newcomer. So Andal's CEO Max Chang calls for an emergency meeting with his executive team. Chang needs a plan before his upcoming conference call with uneasy investors. The executive staff of Andal made the following suggestions to salvage the company's short-term operating results. So all these suggestions are geared towards the short-term operating results. All right, so we have A to G recommendations. All right, 7 recommendations. And the first requirement is to evaluate each of these items A to G, taking into consideration the IMA's statement of ethical professional practice, and we're asked which of these items A to G are in violation of the IMA standards and which are acceptable. All right. So firstly, the overarching principles of the IMA Statement of Ethical Professional Practice are honesty, fairness, objectivity, and responsibility. All right. So whilst the standards, the ethical standards are the 3 C's and 1 I, right? You remember what are the 3 C's? Competence, confidentiality, integrity, and credibility. All right. But the overarching principles of the Statement of Ethical Professional Practice are honesty, fairness, objectivity, and responsibility. The statement's corresponding standards for ethical conduct require management accountants to perform professional duties in accordance with the relevant laws and regulations and technical standards. They must refrain from engaging in any conduct that would prejudice carrying out duties ethically. They must communicate information fairly and objectively, and they must disclose all relevant information that could reasonably be expected to influence unintended users' understanding of the report's analysis or recommendations. All right, so let us have a look at each of these suggestions one by one so that we can determine whether they are in violation of the standard, and if they are in violation of the standard, which particular standard. Is it competence, confidentiality, integrity, credibility? And if they are acceptable, then we'll explain as well. All right, so let's go to A. First recommendation, stop all transatlantic shipping efforts. The startup costs for the new operations are hurting the current profit margins. Is that in violation of any of the IMA ethical standard, or is that acceptable? Well, this is actually acceptable. It's an executive decision of the company to either continue on with their shipping efforts, and if it's not profitable, then they can actually stop. So ethically speaking, it is acceptable. We don't know enough information to say that this is actually illegal. Let's go to the next one. To make deep cuts in pricing through the end of the year to generate additional revenue. Making deep cuts in pricing could increase our volume of sales, of revenue, and thereby generating additional revenue. It may be good in the short term, but if we continue on with that, it will actually erode the profitability of the company. But is it in violation of any ethical standard? Well, it's not really. So it is acceptable. Or it could go gray as well, because if they connive with other parties in cutting prices, that could be illegal, and therefore it could become unethical. But we do not have enough information for now. The suggestion in letter C is to pressure current customers to take early delivery of goods before the end of the year so that more revenue can be reported during this year's financial statements. Now, what do you think of that? This tactic, which is commonly known as channel stuffing, there is actually a tactic particularly referring to this. So it's known as channel stuffing. So this tactic merely results in shifting future period revenues into the current period. Therefore, the overstatement of revenue in the current period will mislead investors to believe that the company's financial well-being is better than the actual results achieved. So this practice would violate the IMA standard of credibility as well as integrity. So X for no, it's in violation. All right, let's move on to letter D. Selling off distribution equipment prior to year end. The sale would result in one-time gains that could offset the company's lagging profits. So the owned equipment could be replaced with leased equipment at a lower cost in the current year. All right, is this in violation of IMA standards, or is this acceptable? Well, actually, this is an acceptable recommendation. All right, it might be in the best interest of the company to lease rather than own its equipment, and many companies are doing that. What about letter E? Record year-end executive bonus compensation for the current year next year when it is paid after the December fiscal year end. Is this ethical or not? Well, this is actually again misleading. So this will fall under the X, the violation of what? Again, of integrity as well as credibility. When you record executive year and bonus compensation, it's actually in violation of GAAP, the generally accepted accounting practice, because GAAP requires that expenses be recorded or accrued when incurred, not when paid by cash. So the generally accepted accounting practice is accrual accounting, not cash basis accounting. Therefore, failure to record the executive's year-end bonus would violate IMA standards of credibility and integrity. All right, let's move on to F. Recognize sales revenues on orders received but not shipped as of the end of the year. Well, again, let's look at the requirement of GAAP. All right, GAAP requires that income be recorded or accrued when the criteria for revenue recognition have been met. So what are these criteria? All right, number one, the company must have completed a significant portion of the production and sales effort. Number two, the amount of revenue can be objectively measured. Number three, the major portion of the cost has been incurred and the remaining cost can be reasonably estimated. And number four, the eventual collection of the cash must be reasonably assured. Among these four criteria, criteria 1 and 3 have not been met at the time the order is placed. The revenue should therefore not be recognized until after the year end. Therefore, this recommendation is again in violation of the Code of Conduct. So, what IMA standard would be violated? Again, the credibility and integrity. Finally, letter G. What about establishing corporate headquarters in Ireland before the end of the year, lowering the company's corporate tax rate from 28% to 12.5%? Would that be acceptable or in violation? All right. Well, this overall is acceptable. The CEO, Max Chang, may have other legitimate reasons for relocating his company to Ireland, but doing so only to reduce his tax liability would be likely considered as an evasion of taxes in the company's home country. So that's why it also falls in a gray area. All right. If the purpose of moving is to evade tax, it's not legal. Avoidance of tax is legal, but evading tax is illegal. So there's a difference between tax avoidance, which is the legal way of reducing your tax, and tax evasion, which is the illegal way of reducing your tax. So if Chang seeks advice from skilled consultants in the area of international tax before making such move, and he is able to show that the primary reason was not to evade tax but for other strategic reasons, then it is acceptable. But it also falls in the gray area, because if it is perceived by the United States government that the only reason why the corporate headquarters was moved from US to Ireland was to evade tax, then he could be fined. If the US government made an investigation, the company could face large fines and even criminal charges for evading corporate taxes of the home country. All right, last requirement. What should the management accountant do with regard to those items that are in violation of the ethical standards for management accountants? As discussed earlier, it is possible that any of the year-end actions that fall into the gray area may be good. In fact, good for investors, depending on the credible evidence that supports the management decisions. For example, replacing the owned equipment with leased equipment may result in both short-term gains for the company as well as long-term cost reduction. If that's the case, then this decision would be in the best interest of the investors and the company as a whole. If the decision, however, only results in short-term gains, then higher costs will be incurred in the long run, and it may not be best for the long-term existence of the company and for the investors as well. So, those decisions that clearly violate the IMA Code of Ethical Standards. In particular, we've shown that to be letter C, letter E, and letter F. All right. So all these recommendations, C, E, and F, would not be in the best interest of the investors. These options would result in misleading the financial statements. It could result in the demise of the company, or it might even result in criminal charges being faced by the management of the firm. So if the CEO asks the management accountant, for example, to take any of the actions that are clearly unethical, C, E, and F, what should the management accountant do if the pressure comes from the CEO to do something that is unethical? Well, the management accountant can raise this issue with the audit committee if there is such a committee in the company. But the management accountant need to inform the CEO that he is doing so. All right. So if the management accountant is directly reporting to the CEO and the CEO is the one pressuring the management accountant to do something that is unethical, then the management accountant can inform an audit committee and inform the CEO as well that he or she is letting the audit committee know. All right. If the CEO continues to force the management accountant to do something that is unethical, then the last resort for the management accountant is to resign from the post. Remember that it's not just the management accountant's interest that must be protected, but it's also that of the profession. So if we as management accountants are seen to be acting unethically, it's not just our reputation, but also the reputation of the profession that is being jeopardized. All right. But resigning, of course, is usually the last resort. All right. Well, this is it for topic 1. I'd like to leave you with this cartoon that I have seen as we close this lecture. It says in this caricature that if you want happiness for an hour, take a nap. How many of you have taken a nap whilst watching the lecture? Hope you didn't fall asleep whilst watching the lecture. It says too that if you want happiness for a week, go on a vacation. Oh, I'd love that. If you want happiness for a year, inherit a wealth. I wouldn't mind that as well. Despite the humor in those first few caricatures, I thought in this last one there is a lot of truth in it. It says, if you want happiness for a lifetime, learn to love what you do. Whatever it is that you're doing, learn to love it. And so I would suggest to you that if you want to be happy for the rest of this semester, learn to love cost accounting. And I do hope you love this subject. All right. And again, I will close with a Bible verse. In 1 Corinthians chapter 10, verse 31, the Apostle Paul wrote, therefore, whether you eat or drink or whatever you do, do all to the glory of God. And that is the key to learning to love what you do. If we are doing it for the glory of our God, we will be happy in whatever field we end up with, whether as a management accountant, whether as a manager, a CEO, CFO, great. If you end up in these positions, that is where God wants you to be. Let's just have a word of prayer to close. Gracious Father in heaven, we are so thankful that you are there just a prayer away. And we just want once again to commit ourselves to you so that whatever we do, whether we eat or drink or do our work or study, we do all for your glory. This we ask in Jesus' name. Amen. Well, I would ask you to do the activities for topic 1, just so that we can cement the idea, the concepts that we have learned in topic 1. All right, bye for now.